I want to start with this idea of the equity market going back to levels that it was pretty much at, the S&P 500, before the start of this war, yet oil prices are so much higher than they were before the start of the war. Is this a floor, or do you think, in the next few months we could see, once again, $60, $65 a barrel again?
No, I don't. I do think this is a problem. That is to say, the resumption of flows through the Strait of Hormuz and the peripheral damage that we've seen for infrastructure, particularly around the Gulf nations, that's not going to be solved. Now, what we're looking at here is a market that has, let's borrow the term, irrational exuberance. They want to believe this war is going to be over. And perhaps it is. And I hope it is. And I hope that there's a positive resolution. But what we don't have a resolution to is the amount of damage to infrastructure that's been inflicted upon the market. So we're looking at the futures markets. And these are contracts that are derived from a physical market. But there is a massive disconnect now between the physical market and the futures market that you just referenced. So, for instance, NYMEX WTI, yes, is trading about $95 a barrel, to your point correctly. That's 50% higher than where it was in February. But when we look at the actual physical market, we're still trading, well, one blend of North Sea crude oil is trading at a $40 premium to where the screen is trading. So the futures market are pressing in some kind of hope, and hope is not a trading plan. The physical market is telling us that we are a long way from seeing any sort of resolution, that is to say, a resumption in prices going back to where they were prior to the conflict.
You mentioned physical infrastructure, so I want to dig into that a little bit. We just spoke about the Strait of Hormuz and that being a choke point. Let's say the Strait of Hormuz does resume normal traffic, 120 roughly ships a day moving through it at some point in the near future. Is that enough to bring prices down, or is the physical damage to physical infrastructure creating this floor until that physical infrastructure is fixed?
It's more so an issue in the natural gas market than it is the oil market.
Okay.
So we'll see that. Let's say we do get that resumption with the infrastructure. We're still at least one quarter away from seeing any sort of return to a normalization, as it were. Now, that's a concern, because what happened, and this disruption occurred beginning towards the end of the first quarter. This is the weakest part of the calendar for demand for crude oil. Refineries in Europe, in the United States, and through the Middle East, they go into what's called turnarounds, or their maintenance season. So they ramp down operations to get ready for the summer peak season. So demand from the only people that actually consume crude oil, the refiner, was at its lowest point of the year. We're now well into the second quarter, transitioning into the summer, where demand is going to spike. So even if, best of all worlds, we get a resumption to flows, there's still going to be a lag, and that lag is going to run up against the demand that is about to hit the market over the next month and a half. So we are looking at a very volatile summer coming in. Now, the natural gas market, and when the natural gas market, we're talking about not only just gas to heat our homes and for our stovetops, but the knock-on to what we're seeing in the fertilizer market, because natural gas is such a big price driver in fertilizers and urea and helium and so forth. And we were talking about 20% of the world's LNG capacity has been sidelined, and it's going to remain sidelined over the next 3 to 5 years with hit to Qatar. We're looking at a knock-on an inflation mechanism that is, well, we are watching history in real time right now, because the entire global natural gas market has been turned on its head, and it's not going to return to anything before what it was like prior to the conflict.
Yeah, some of the Qataris I've been talking to have said that's going to be a minimum of 3 years before they can get that LNG network back up to current levels of production. Of course, that also impacts other things like helium production. But before we move off oil, I do want to go back to something you were talking about, and that's seeing the surge right ahead of summer demand for oil. Everybody's trying to travel, everybody's trying to do things. That takes oil. Where are you going to see the downstream effects, and where are normal people going to see this impact them the most?
Well, we're going to see it, of course, at the pump at this point. And right now, when we look at what we saw in the rise in the wholesale market, and a significant rise, more than $1 a gallon, more like $1.10 a gallon, I should say. Statistically, there's about an 87% pass-through of what we see, the hits to the wholesale level that come down to the retail level. So currently, what we're right now is in a position of two factors. You have, of course, the war hit. That is adding a significant hit to the pump for the consumer. And then we're also now in the midst of the transition to a different type of gasoline. The gasoline we put in our cars in the months of June, July, August is not the same gasoline you put in January, February, March. So that gasoline summer grade, we'll call it, comes at a premium because it's a much harder blend of gasoline to manufacture. So we normally get a 17 to 20 cent increase at the pump just for that seasonal shift. Now you add about 80, 90 cents pass through of what we're seeing in the war premium, we're looking at $1.10, $1.20 additional hit. So right now, national gasoline prices, AAA, I think right around $4.14. We modeled it 3 weeks ago. On the pass-through, the typical pass-through you see 3 to 5 weeks after a significant spike. We modeled our prices between $4.17 and $4.20 national average. Now that's an assumption that prices remain here, but I don't think they're going to remain here. So the knock-on to the consumer will certainly be higher. More towards, and I wouldn't be surprised if we go and challenge the $5 premium that we saw 3 years ago.
So what you're telling me is I need to find a nice walkable summer vacation plan.
Well, just stay in New York the whole time.
Yeah,
that's what you
exactly.
Hey, Stephen.
I'm here in Philly. I can't walk to the Jersey Shore, so I'm going to have to drive.
All right.
Hey, Stephen, one thing that commodities traders like to talk about is the cure for high prices is high prices. When prices move higher, other producers come in to profit from that. Have we started to see that when it comes to drilling in the United States or production in the United States? Is this enough for American producers to do what the president wants them to do, and that's drill, baby, drill?
Yeah, certainly. Well, interestingly enough, when oil was at $60, $65 a barrel, we were seeing record U.S. production. I was quite perplexed by that. Right now at $95, $100 a barrel, call it, certainly prices are high enough. Now, they're high enough, but are they going to remain high? And that's the issue. We are seeing some hints, particularly when we look at the CFTC data, their commitment to traders reports. When we look at the disaggregated portion of that report that serves as a proxy for E&P hedgers, then we're seeing a significant amount of futures markets sold forward. So what we can say with confidence is that E&P producers are selling this conflict. Now the question is, are they selling it? And then they're going to meet that with future production, which would be the implication. That remains to be seen. But typically, the knock-on is you'd want to see months of a new pricing regime that we are in, rather than just a kind of a short-lived, okay, this is a futures market that is trading with every whim, every social media post that comes out there. That's not a fundamental physical plan right now. So we do know that is, again, I'll reiterate, that a lot of oil has been sold forward by the producer class. Now, that could be a speculative hedge. It could be, but it's not. So the likelihood is we will start to see production ramp up to meet this. But the question is, can we get that production from where it is to where it needs to be in the amount of time that we need? And that is, the answer to that is no. So from a longer term perspective, we might see the indications are there, but will it make enough of a difference to impact price without other factors being addressed for this summer? Unlikely, no.
Stephen, very quickly, we've only got about 30 seconds left. I do want you to talk about fertilizer. You say it's not tight, it's breaking. Helium, how that's going to impact AI expansion. What are the big red flags that are most concerning outside of oil?
So right now for the natural gas market, of course, is fertilizer and what this means for food inflation. So our two biggest components, as Thomas Sowell said, inflation is not a problem if you don't have to eat or turn your lights on because food and energy are excluded from the official CPI numbers. So that is the hit that we are going to see. We're seeing it front-loaded in the energy complex, and if this persists, and it will, we'll see at food inflation down the road. More fertilizer, higher prices, to put the seed in the ground, higher price to get the seed out of the ground, higher for your kitchen table.